Normally we actually have several different speakers that join us for these lecture series, and that's been a good format that we've used in the past. Today we wanted to open up this particular lecture to one speaker, and that is Mark Foster. Some of you may know Mark because Mark was born and raised here in Fairbanks, Alaska. He spent at least the first part of his career here. Mark has an interesting background in that he's both an engineer with a civil engineering degree from Stanford University, has been at the University of Alaska as part of his studies, and then has also been working really on the economics of a lot of the energy projects, infrastructure opportunities and such in Alaska. Mark also previously worked for the Fairbanks Municipal Utility Services, what we know now as the Aurora Power Plant. Worked there on some capital improvement projects. Eventually he moved on to become the commissioner for the Alaska Public Utility Services from 1990 to 93, and now currently he's working as a utility consultant and has worked in really just about every area that has been of interest in the state of Alaska in terms of energy projects throughout his career. I actually thought it was pretty interesting that his senior project report when he went to Stanford University was on the economics of Susitna hydroelectrics. So that was, I didn't ask him how long ago that was, but I suspect it was a few years back. So anyhow, Mark, you have a little bit of a different format for us tonight. We're going to have a little bit of audience involvement in tonight's lecture, and I think that I, for one, am certainly looking forward to it. So if you could please join us.
Thank you, Gwen, and thank you for joining me here tonight. We'll just go ahead and walk down through it. Where's the Alaska energy future headed? And what I want to try to do is give you a little bit of a guided tour, in part by looking back at history, and then going forward, I want to seek your input through a modified Dutch auction to go, what do I think the price of gas is going to be? And I want you to raise your hand until I get it high enough where I got most of the audience. And similarly for the capital cost, what kind of overrun should we anticipate? And interact a little bit with the data to get a feel for how important assumptions can be in the outcome of comparisons between various technologies and projects that we frequently hear about. Let's see, speaker bio, I'll give you a few other snapshots that I think are useful to know. We'll look at the history of energy in Alaska at a very aggregate level. We'll look at some market considerations about how we think about energy markets in Alaska, sort of segment those out. Look at the key economic assumptions to consider as we think about our energy future. And then I want you to vote. And I want you to think of this vote in two different ways, because I think this is a really helpful exercise. We're going to have a primary election, and you vote your heart. What do you want to have happen? And then I want to have a general election where you vote your mind. What do you think is going to happen with various key assumptions? And just see how it goes differently, recognizing that it really is a group process here, as it is in the public policy debate, and a group process within companies as they figure out what are we going to do, where are we going to invest, where are we going to go. And finally, we'll look at some of the results from that. And this is, for those who haven't done it, there's a lot of spreadsheets here at the tail end. There's a lot of numbers. So just heads up warning, and I hope they're big enough on the screen so we can have a pretty good interchange. If they're not, please, wave your hand and go, help me understand what some of the numbers are, because I think it really is central to this conversation is what are the risks that we're talking about, what are the rewards and the opportunities, and finally, there's a value component that I think we frequently leave out when we're analysts, but I really want you guys to work on when you think between that primary election and that general election, working with your heart and your mind. Some of the stuff that's useful to know, because it's in the full disclosure realm. I'm currently on the board of directors of Alaska Power and Telephone. We've got some small rural properties in the interior. We've got Tok being one of the more prominent ones on the road from here. We've got properties in the southeast. The headquarters is in Port Townsend. And we do both power and telephone. And from time to time, we've looked at business development opportunities in the Railbelt. So, I have that as one of the perspectives and potentially biased. Hydro West International is a hydro development company that does work in Central America. We've built projects in El Salvador, and we're evaluating projects in Guatemala. We've built and sold one in El Salvador and achieved some nice returns. It's a very interesting, sort of process where you're really building, owning, operating, and turning them over, and just understanding that whole development process in a foreign country and comparing sort of capital investment there to Alaska. North Slope experience, I think that I bring to bear with North Slope Borough and with Kupik Corporation in New Ixet, who's developed some natural gas for their local community that you may be aware of. More recently, some work with the city of Palmer on a district heating opportunity. They're thinking about putting a power plant in at the state fair there in Palmer and distributing heat out. To give you some of the more recent stuff, I was on the board of directors of Anchorage Municipal Light and Power and the chair of the Finance and Audit Committee in 2009, and was very much involved in the conversations about forming a regional utility, and so have some exposure to that. I think those are probably the main things to keep in mind. And once upon a time, I was on the City of Fairbanks, the Model Energy Code Development Committee with Steve Shuttleworth in about 83. I think it was, when we were talking about what insulation standards should we have and what requirements should we have for vapor barriers. Anyway, all right, history of energy in Alaska. When we look at the total energy consumption in Alaska by source, going back to 1960, and working our way forward, 2006, 2007, so there's some stuff in here that's changed, but we've got coal, we've got natural gas, you recognize the Cook Inlet stuff, and then the Prudhoe Bay stuff coming online, the Prudhoe Bay power plants in here, and some of the stuff that goes into the pipeline. Diesel fuel, jet fuel in blue. You may recall we're very fortunate in having airports strategically located. So we really have a lot of traffic, essentially an export industry with the jet fuel servicing all the air traffic, and you see that in blue. Motor gasoline's in the yellow. Pretty small slice relative to your expectation when you first look at the data, it's my experience. And then you'll see going all the way up there, you've got hydro is that blue at the top. When I look at the total energy puzzle, Alaska, looking back over time, and that's the EA, we've got a source. EIA, historic energy consumption for Alaska. All right, now let's dig into that a little bit and just see where all those various energy consumptions are. And we're going to look at a little bit of transportation, heating and electricity, and segment some markets down into residential, commercial, industrial. I haven't had a chance to split out the government, which I want to do at some point and sort of look at that as a separate and distinct market. Transportation, energy by source. Looking across the data, you'll notice now, let's go back to that first slide, billion of BTUs per year. It's useful to remember the scale here. We're about 900,000 billion BTUs per year. But keep in mind the 900,000 to give you the scale as we drill down into transportation. Slightly less than a third on the scale here. And the big ticket item is jet fuel. We're putting a lot of jet fuel into planes that are flying all around. Some of it in Alaska, most of it coming to and from here because of our strategic location. Look how small motor gasoline is at the top, that blue. Jet fuel dominates the equation when we're looking at transportation fuels, when we're looking at the total picture. Residential energy consumption by source. Natural gas and diesel fuel are the two big ones coming across. Natural gas and diesel fuel. What's that one on the top? What's that big bar at the top? electric system losses. When we generate electricity for residential customers, and you'll see it for commercial and industrial customers as well, a whole bunch of the energy goes up the stack. Some of that is recaptured in combined heat and power and sort of reuse and waste energy, but a whole lot of it isn't. So when you're trying to total up the total energy consumed and the total energy that gets to useful purpose, that becomes a bigger and bigger factor when you think, how efficiently are we using our generation side in addition to thinking about how efficiently we're basically doing our end use side. Commercial, we've got coal on the bottom, natural gas coming in, and again, electricity system losses dominating on the top. Industrial, Cook Inlet, Prudhoe Bay are the dominant features here, and it's energy for the pipeline and energy for Prudhoe Bay and energy for Cook Inlet, and it's mostly natural gas running turbines. All right, so what? We've got a bunch of history, we've got some patterns there. What does it tell us? What does it tell us about energy consumption, and how does it inform your view of the future? All right, this is your chance to offer something up. Rich Seifert, what do you think?
Well,
You've been following this for a few years.
We're way more important, we're way more dependent on jet fuel than we think we are,
Okay.
and jet travel.
And jet travel, and that jet fuel really does have a pretty big influence on the refineries that we have here and what kind of margin they might have. It's not unlike the analysis of coal for coal supply. How much of that coal is going to an export market, how much of it's being used domestically, and how do those support each other? And I think the diesel fuel and jet fuel and naphtha markets are really all quite interrelated, and gasoline. And so you really have to watch it when you're looking at one, because they really do all interrelate. And in many ways, we've been very fortunate at our strategic location to have all that jet traffic and be able to sell them fuel that's competitive. Now going forward, is that situation going to continue? How far can a jet fly now on 2 engines? It's really efficient. We have an exposure, I think, a risk going forward as technology increases across all kinds of different fields, not the least of which is air transportation. We get more, there's more and more of a risk of bypass. And largely it's driven by sort of safety regulations. It keeps the bottle on some of it. What other things might there be in that data? Yeah?
You had a graph that showed either waste heat or waste energy, and I was wondering what the source of that was and what all it included.
Okay.
What was the source of that data?
The data is all the EIA historic energy consumption data that they compile. And basically what it does is it makes, it compiles the information from the electric systems that file reports and takes that data and then goes, how much of this input, natural gas, HEGO, naphtha, diesel going in, how much of that is useful energy going out and how much of that is basically heat that's not captured for the end use market.
So this is thermodynamics and not line loss.
Not, line loss is a piece, but thermodynamics dominates, clearly. Yes.
Got a question. In your industrial graph, the large piece of natural gas there, we never see. It's all burned in Prudhoe Bay.
Most of it is, yes. Cook Inlet gets a piece and Prudhoe.
Since the early 70s up there.
Yeah. Yes.
This is something you might be getting to, but have you done any modeling to see what that would look like if we could reduce the electric system losses?
Generally, on forward-looking stuff, I'll look at combined heat and power plants. If I'm looking at a new power plant, well, looking at UAF, how do I build a power plant that uses both the electricity generated on the plant and the waste heat, because that's a pretty efficient way to go in terms of using the resource. If you have relatively compact and high density energy uses, combined heat and power is a pretty efficient way to utilize your resource. And the good news is that's efficient. The bad news is that may lock you in because it's so efficient. Competitors have a really hard time getting in if I'm using other technologies to get in under that price because of the efficiency. Yeah?
Why would you show the losses associated with thermodynamics on the electrical side, but not like on the jet fuel burning side?
Good question. I haven't dug into the data deep enough to understand why they've done that for accounting purposes. I just don't know. Yeah?
Gary Newman here. Question on the jet fuel. Obviously shows a pretty large picture compared to gasoline for us normal mortals. And as we know, gas prices are pretty high for us. And the report that was done showed that they were doing that so that they could help subsidize the jet fuel to keep it lower so they would remain competitive. How much margin is there for them to remain competitive? If we're such a small piece of it, it seems like they could be reasonable about it for the rest of us without having to lose their jet fuel market.
Short answer is I don't have enough public data to give you a good answer to the relative margin question. And let me suggest that when I did an analysis once of the coal margins at FMUS in the 1980s, that we were indeed paying a higher price at FMUS for coal than, say, Golden Valley or the export coal. Then the question became, so I'm paying a higher margin, how high is that relative to what I would expect to pay if we didn't have the export market? And based on that coal analysis, I came to the conclusion that that pricing probably made competitive sense given how competitive the international market was for coal. I do not know whether or not that's the case for the refinery. I don't have the data. But I think it's an open question that you'd have to ask. Does that get partway there?
Well, we're not there yet.
Okay. Brian?
It seemed that if you look at the graph of residential, relatively stable compared with everything else. Moderate growth post-pipeline versus explosive growth in other sectors.
Yes. No, I think that's definitely a takeaway, and I think it's consistent with employment that we see across the state and a lot of other sort of general economic indicators, relatively stable. And it gets, thanks for raising that, because it gets me back to a question and that sometimes people think about, well, how much efficiency over that time period. And as a general matter, we have become more efficient on a dollars per square foot basis for building facilities, for example, but we've expanded our footprints. We've gotten richer and we've built bigger houses. That's the data that I'm seeing when I'm looking at South Central. The efficiency's basically been spent on bigger houses out in the Matt Valley, down in the Kenai, within the Anchorage Bowl. And so the weatherization programs and the weatherization sort of interest that we had in the 70s when we had a sort of peak in pricing, and then subsequently in the 80s when we had more state money around to help pour into some of those programs, the net result in some respects, as we look at it over decade time periods, is the wealth and the better insulation and better efficiency led to larger sort of houses and ultimately to more commuting, at least in the Anchorage area, coming in and out of town, and a large growth in the population out in the Matt Valley. Rich?
Can you, I mean, that spike from 1975, that just looks very suspiciously like all pipeline related.
Yes, and that's my hypothesis. I haven't been able to drill down and sort of verify how much of that is the end of the pipeline construction and the outflux, if you will, of a bunch of the temporary workforce versus other factors that might be at play. That's my theory. Okay. All right, looking forward, I want you guys to think about oil prices. Where are they at? Where are they going? not just the volatility that we have, but where might they be out a few years? Natural gas prices. Where are they at? Where are they going? The cost of project development. Normally we stick capital costs in this category, but I think it's really important, particularly in the Alaska context, to think in terms of capital projects over their life cycle as you develop the project and then get it far enough along where you can finance it and then go out and try and construct it and then operate it. Because a lot of costs get built into projects up front, and a lot of projects don't get built because of the upfront costs as opposed to some capital cost number you might see. And then we'll talk about environmental considerations as they are monetized into energy projects, and then the economic discount rate. What's a good economic discount rate to use? I want you to start thinking about that. What does that mean?
That's your job.
What does that mean? It's as much a value judgment as it is anything else.
0.87.
There you go. Pick a number. All right. Crude oil import price, and here we have in the bottom, let's see if, oh good, the colors are the same. The low, the base, and the high are from the EIA Annual Energy Outlook in 2009, and the International World Energy Outlook is the sort of the turquoise. And you'll see the mid case for the EIA, the US guys, and the mid case for the international guys in Paris for oil prices. They're reading the same stuff. They're talking to each other. Looks pretty close. It's kind of interesting. Huh. Keep in mind, this is after the peak in 2009, slightly after, and they're sitting down and going, oh my God, prices were up to about $145 a barrel. They flew down to 40. Where are they going now? So they looked at each other and said, it's in this range. Now, what's the other thing that's important to note? Look at the span between the low and the high. And you hire people to do this? Think about it for just a minute. $50 a barrel, we're in 2009, real dollars. 200 going to 250. That is a huge span. How do you make investments with that uncertainty? How much capital would you gamble with that much uncertainty? It's your own money. Think about it that way. If it's your own money, how much gambling do you do against that uncertainty? Natural gas, same reports. EIA 2009 Annual Energy Outlook, International Energy Association Outlook, roughly the same time. What's that turquoise thing way at the top? The Europeans' view of natural gas is the Middle East and Russia are not reliable. And we can't trust those guys to give us gas, so we're going to project really high-priced gas. The U.S. view, in recognition of shale gas and other unconventional gas resources, coal bed methane, etc., you'll notice their more level projection and how tight the error bar is around the prices. The yellow to the, what is it, kind of a fuchsia? Yeah. Look how tight that is compared to oil. And look at the Europeans' view of gas prices. Wow. They sort of see the same thing in oil, which may or may not be right. And the US guys go, but the uncertainty is kind of big. The US gas guys go, we don't think there's a lot of uncertainty. We think there's a lot of supply out there in the world, and there'll be demand, but it'll be catching up to the supply. We're going to be basically supply side driven, not demand side driven in the US. The Europeans, they're very worried about supply. So what's the price of oil and the price of gas going to be for Alaska as you look at this stuff? And I think the answer is there's a lot of uncertainty. And how do we deal with the uncertainty when we think about how much is it going to cost in the future? project development. Okay, let me go through this graph. Alaska Hydro Project Reconnaissance. I went back through the Alaska Energy Authority database of hydro projects, and there's over 1,000 projects in the database, and looked at the ones that turned into a hydro project that was built. Then I went and looked at what was the actual total cost of that project installed versus the estimates. We got an estimate from some professional, and then we had an actual. What's the ratio between the actual cost to the estimated cost? That's this axis here. It's linear. There's 1. So if you nailed your estimate, and the actual cost came in, that's basically this range right in here. I've got a log scale on the bottom, installed capacity. So you got the small, sort of the 1 megawatt or 1,000 kilowatts here, 10,000, and then you've got Bradley Lake out there on the far right, coming in at about 1.4 over the estimate. You've got one of the 4 dam pool projects coming in at over 2 times the estimate. I'm trying to get the data on the others and comb it down so I can put it in the chart. But they look like they're well above 1. And so what do I see when I look at this data? I scratch my head and I go, smaller projects might be something that we can control costs better on. It's preliminary. It's not a big sample, but it's worth thinking about. Questions on that? Okay. Combination. Some of them have been built with state funds. Some of them have been investor-owned. AEL&P in Juneau, for example. Alaska Power and Telephone, we've got a few projects in that base. So there's a mix. It's not all one kind.
So what would be interesting is you'll take out the bias of the thin projects, right? You should have, this graph should account for projects that got funded that never really got completed.
You could do that. I'd be inclined to try and do ones that made it to a point where there was a decision to invest and then capture all of those. Because I think that's useful because I don't want to necessarily penalize reconnaissance, even if you put a fair amount in. Because I think there's a lot of reconnaissance that's actually good discipline on the cost side. So I'm really interested to see, for my purposes, for thinking about projects, when you make the decision to commit the major capital, then where do you land relative to your estimate? And that's really what I'm trying to capture. But yeah, there's definitely several more projects to add, and but I do think, well, there's a few other things further on that'll come back to this. Okay, environmental considerations in project development, and then we'll talk about a little bit about greenhouse gases and what carbon price we might want to think about and compare some projections. One of the big considerations in any energy project development is basically what local concerns might there be, what permitting requirements do I have, sort of what are the constraints on that project development. And so I'm thinking, okay, where can I find sort of a data set where someone's taken a look at that who's not so close to the ground that they know all the local politics and sort of are picking a project based on local knowledge. And I found a database, and it's out of Idaho, the database that's used in the national energy model to figure out which projects, which hydro projects, look like they will get through permitting and various local issues that might come up. There's a reconnaissance work done out of Idaho to basically look at hydro resources. In Alaska, they've looked at a great database of Alaska hydro resources, and this is in the national energy data, and they go, okay, what's the probability that any particular project on our project list in Alaska will get developed? And if you look on the far right, you'll see the probability of development from the Idaho analysis. You'll see the relative size of the various projects stacked up, and you'll see that they have 438 megawatts on the 90% development probability. Chakachamna fits in that stack in that project. Yes?
Federal engineers that are got an assignment from some national lab?
It's basically the national lab, yeah. And you know, it's one of those paper recons where someone's trying to take a high-level recon based on what they can find. And it's 2003 data, but it still rolls forward into the national energy model that's updated every year in the annual energy outlook at the EIA. So if you're trying to look at that and figure out, well, where's the hydro numbers coming from, it comes back to here. This is the underlying source data. 75% probability of development, you got another 533 megawatts. You got this big slice, which includes Susitna at 1,792, 50% probability of development. Well, why did they say Susitna is at 50 and Chakachamna is at 90? Size of the project and all the environmental, basically, impacts. And this is from someone at 20,000 feet, basically going, all right, how do I sort this stack out? I don't offer it up as anything definitive, but an interesting outside perspective at how the hydro development looks when you are a hydro specialist, as they are at Idaho, but you're not on the ground here. The other thing I think is interesting is 72% of that capacity that's identified is a 50% less probability of development. So I scratch my head and I go, okay, what are they telling me? What they're telling me is there are fish issues, there are parks issues in Alaska, and only about 13% of that resource is really available that doesn't have an impact on a park or a potential fishing impact. And that's why when you look at some of these big national surveys about the potential for renewables, hydro included, you have to discount that for what you can actually develop in a particular location. And I think it's interesting to look at the national data at what they think will happen in Alaska. Questions, comments? I think it's just fascinating to look at how outsiders might view it. Yes?
The sort of budget to actual you did on hydro, have you done that for wind?
I haven't done it for wind. I don't know that I can get the actual data as easily at this point. But it's probably worth doing. I'm just trying to think through where I'd get the data. Yeah, no, I haven't done it.
Are they tracking, same question on the same graph, are they tracking the operating costs as well? Or is there really no?
When I've gone back through and done work for the Energy Authority looking at rural energy and the grants that go out there, as a general matter, they see the operating costs through the PCE filings. They don't independently track it, but they see it basically through the PCE program, and they check to see are these reasonable expenses. So we do have the information. I don't know that it's necessarily analyzed in great detail as a general matter. So we do have it for rural. I don't know that we have the same level for Railbelt and Southeast if they are not on PCE. The short answer is we have the Railbelt data, but it's through the cost of power adjustments. So we do have most of that data. We do have most of that data. What's the next step on that question so I can close the loop? I'm just thinking about data, I'm sorry.
No, I mean, thinking about going back to the investment.
Yes.
And how you're going to track the return. You know, I've seen lots of project developers come with pro forma, and you know who can develop or not because you can pick that apart and go, these numbers are off. This doesn't make any sense. Your numbers aren't going to work. That impacts your IRR and
Yeah.
return.
Yeah.
So if they're not tracking, I mean, someone's got to be looking at it to see.
And
the project sort of makes sense, you know, in reality versus in a spreadsheet.
Yeah, and and I think the question in my mind comes down to how good are we at learning from what we actually do compared to what we were planning. And I would say both public and private sector folks both have a long way to go to learn from mistakes, because they frequently don't. And it really, I see that happening on both sides. Yeah?
The availability of steel from China, because U.S. steel is no longer. It isn't there. There's no steel making in the U.S. So we depend on foreign. You depend on foreign for the wind turbine. You depend on foreign for the steel and any kind of hydro project. And that cost, just for the transportation, makes these just, you know, it's just pie in the sky. It's just not there. Once Alaska realizes the resources that they do have, and kind of get on a ball, you know, get with the program to see this big state with all the resources, but no infrastructure for manufacturing the steel, the rebar for a dam, the wind turbine, the rare earths for the magnetic motor generators. We're just going to be, you know, kind of chasing this pie in the sky in China. So where is the economics in that? There's not.
Let me offer a couple observations, because I think it's a point frequently raised, and we sometimes dismiss it and go, well, we just go for the low price and it doesn't matter. But it's more complicated than that. And let me offer a couple examples, maybe illuminate my perspective on it. Hydro development in Central America, we frequently purchase equipment from the US, from Europe, and from China, and we integrate it. We're integrating from 3 different places that don't necessarily have the same standards. So what do? Is it worth your while to go and make sure that stuff will actually work together before you buy it? Yeah. So you send people out, you go check it various ways, buy the stuff, bring it together, and put together a successful hydro project. I think most of the world today operates with that framework. If I can make this work together and it's reliable, let me try and make it work. Here's the exposure I think we face when we're in that framework. We're buying some generators out of China. The cost on some of the generators was 1/10 what it would cost us to buy them in the United States. 1/10. Landed, installed, they worked. Next time we go to get the quote, they're up to 90%. Exchange rate hasn't changed that much. They figured out what they had. So the exposure, I think, ultimately isn't just is there going to be a supply there, but the supplier getting smart and going, now I understand the market, now I'm going to test it. And at some point, it's not just whether I can get it, but at what price. And I do think there's a lot to be said for, do I have a secure supply of critical materials? Because I do think we can get burned sometimes if we get in a narrow frame of, I'm going to take something that's inexpensive, we'll work together, but ultimately, if I have to go back and buy some more of that, will it be at a price that's reasonable that integrates into my system? Yes?
In project development, there's a couple components, inflation and time frame. The larger projects will take more time, and you're at risk for loss then as time goes on. It's obvious in your graphs.
Yeah, no, I think that's certainly an exposure, and I think it's a particular exposure on larger projects in relatively small markets, and a lot of vendor-driven procurement decisions and a lot of vendor sort of driven schedule decisions as opposed to the buyer driving the agenda. I think it's a risk we have in smaller markets. Yeah, Rich.
Has anybody ever conceived of the prospect that, supposing you have long-term economic stagnation or contraction, and inflation is the problem, but deflation is?
If deflation's a problem, do you want to have a big payment for a hydro project? Is that what you're asking? Or a nuclear project? Or a coal-fired power plant? Well, let's talk about economic discount rate. What's up there? Why is that? What do you think? I want to challenge you guys to think about this, because there's sort of a technical analysis that economists do to come up with the economic discount rate. If I'm a state looking to make investments, state of Alaska maybe making infrastructure investments, federal government making investments, private sector making investments. And what is the economic discount rate really attempting to capture? What's the opportunity cost? If I spend this money here, what did I give up? That's really what it's about. What's the right number to use? What's sort of that lost opportunity if I make an investment? And how should I sort of evaluate that? If you're OMB, Office of Management and Budget for the Clinton administration, you do a bunch of analysis and you say, you know, for the federal government, that number should be about 7% real in 1992. And for those of you who follow, that's a pretty high discount rate, which makes it hard to justify large capital investments. In Alaska, at the Energy Authority, we frequently have used 5% based on the long-term real returns on the Alaska Permanent Fund up until the stock market crashed. And so now there's sort of a discussion about, well, is that the right number or not for a state of Alaska for a discount rate? Those of you who followed the Stern report or William Nordhaus or some of the others that were looking at climate change debate, the discount rate there goes basically on down to something approaching 0. What discount rate do you use? What does that mean, discount rate? It basically is, what's a dollar worth today compared to a dollar tomorrow or the next day? I've got it today. I've got all my options. Now, if I invest, I'm giving up some options. I'm creating an opportunity cost. That's really the heart of it. It's as much a value judgment as it is an expert judgment, because all those things come to bear. When some economists have gone out and said, well, you know, I might have an opinion, but I want to collect a whole bunch of opinions and see where they come in, they frequently find that discount rate is a lot different than the point estimates that they might come up with at the Fed or somewhere else. There's a lot of bias in the discount rate number, and it can be pretty critical. All right, we're about ready to get into the voting section of the presentation where you get to vote on prices and costs. This is pretty thick sort of spreadsheet sledding, and if you would, bear with me so we can look at the numbers, look at the results in our primary voting without sort of seeing the results and the assumptions at the same time. Then we'll come back and we can tweak in the general election, knowing a little bit about the interaction. So I have to get into Excel. Let's see if I can find it. Okay. Sneak preview of coming attractions. I'm going to simplify this a fair amount, but I think it gives you a feel for the numbers. And I'm going to look at some hydro project, coal-fired project, gas-fired project, so you can get a sense of the differences between those major sort of base loads for electricity and how they stack up under various assumptions. Now, what are the key takeaways? Let me just pick one here. All right, as the introduction. Okay, you can probably see that. All right, what do we have? We've got a coal-fired power plant in South Central at 100 megawatts. We've got the Healy Clean Coal Project being restarted We've got a gas-fired General Electric turbines. We've got some slightly larger scale General Electric turbines. And then we have a few estimates for the Chakachamna hydro. The reason I picked Chakachamna is because I got spread in the capital cost estimates. And when I look at Susitna and look at those capital cost estimates, they're all kind of staying in the same ballpark in terms of dollars per megawatt installed. And I don't get much spread, so you can't really see as much. This isn't sort of the Chakachamna wins over Susitna. That's a separate discussion I'd be happy to have, but we're not going to do that one today. So that's what we've got laid out here. And what am I looking at? The bottom bar is the capital cost. The next bar up is the O&M cost. The yellow is the fuel cost. And the top are the environmental considerations. Greenhouse gases are a big dominant piece. Mercury emissions are in there, SOx and NOx are in there, so those things are part of the puzzle. And I've got dollars per megawatt hour for the total sort of levelized cost for those various projects. Here I'm using that 7% real discount rate from the Fed at the OMB, the federal OMB. So what does this tell me at some really high level before we dive down and do the votes? Capital costs are important on coal relative to gas, but they're swamped by hydro capital. Hydro capital is a swamper. And it's similar to the profile you get when you do nuclear. Capital is everything. Capital is everything. What's your capital exposure? Is how good a cost estimate do you have? Now, I took the Chakachamna estimates that Bechtel did in 1982 and brought them forward to 2009 using capital cost escalators appropriate for hydro and construction projects. And then I compared that to the Chakachamna estimates that have been put in the public by TDX in 2009. That's the spread you get between those estimates using a levelized cost approach, the 7% real discount, and a 50-year time horizon. It's a pretty good spread. There are some material differences in what's in the capital cost, but I think it's instructive at the spread you have there. Okay, any questions on that before we dive in? Henry?
On your 50-year horizon, you're assuming the hydro often lasts longer than that. You're amortizing it over 50 years anyways.
Yeah, I'm just using 50.
So there's a good chance it'll last longer for that particular resource.
Yes. If the total project cost probably, spread out longer, yes. And when you go to a lower discount rate, you also see that same effect. And we'll run a sensitivity so you can see that. Yes?
The ACEP is dormant, and there isn't anything over the horizon to where it'll wake up. I think that needs to be noted there.
Yeah, I'm not sure that my notes are fully developed, but yeah. Basically, what I did was I took the public disclosures that Golden Valley made when it talked to Homer and others about restarting it, and used that as a snapshot about a potential restart on a coal-fired power plant. And I think the thing that's interesting is because a bunch of the capital has basically been sunk, and now the incremental capital cost for ratepayers is really quite small, it becomes a relatively competitive resource in the big mix, recognizing there are risks associated with coal-fired power. But we've captured a fair amount of the emissions risk in that environmental cost. Yes?
I'm just curious, if you've done any weighting based on the megawatts per project. When you look at the Healy project comparatively to some of the others, and you only get 50 megawatts compared to some of the others, just wondering if that's been taken into account, the long-term megawatts versus capital and other costs?
Not in this analysis. You'd get that if you did an integrated resource plan or sort of a resource stack. I haven't gotten that detailed because that's really hard to present in a group and get sort of feedback. Yes, Brian?
Mark, your environmental costs are essentially carbon tax or other environmental related and not the capital costs of environmental permitting on any of the projects?
That's correct. The capital cost implications for environmental considerations. For example, on a hydro project, because of water limitations, I may have to increase my capacity so I have enough water for power and for fish. That's in the capital cost. That's correct. Yes?
Your Chaka doesn't show any of the environmental turquoise color there.
Right, because the environmental considerations like fish are inside that capital cost, and the turquoise for environmental, and we'll dig into it here, is basically emissions. I warned you.
I'm not necessarily asking that. It's the price of the, the cost in water to get the cement, to get the rebar. It takes a lot of that. You're wasting water there. Isn't that an environmental question?
Yes, and I think the way it's framed in this analysis is, here's the capital cost estimate if we do all the things we anticipate in Bechtel, and here's a capital cost estimate from the more recent project proponents where we don't do quite as many things to take care of the environmental considerations. And so that's partly what you see reflected in that spread of numbers.
But I didn't see the turquoise color in the...
Yeah, that's because I've got it rolled into the capital. And partly it's because I really want to test the sensitivity of each of these projects to carbon emissions, the CO2 or greenhouse gas tax, and what you might think that rate should be. So real quickly, let's see if you can, oh good, okay. You've got the capacities for the various projects, the capital cost based on public estimates, contributed capital in the case of the Healy coal, so you've got a net capital that you've got to pay for the ratepayers going forward. You've got the gas projects, and then you have the hydro project range. And those are dollars per kW installed. Some guesstimates on economic life that we can change if we want. That real discount rate. How much output gets sold, essentially, is the annual capacity factor. Does it run hard and basically produce a lot of stuff that can be purchased? Fixed and variable O&M, fuel supply for coal versus natural gas. And I want you guys to ask me, well, how come you've got about $9 for natural gas? Where'd that come from? But you get to vote on that.
How come you got $9 for that?
Because we're paying 8 and cook endless.
We'll drill down into that one. And you can put a number in there that you like, but I want to make you break down and do a little bit of work for me on that. And then the greenhouse gas cost, what's $1 per ton of CO2 and CO2 equivalents? Who knows what that number should be? I just threw a number in there. You tell me what you think it should be. How do we even guess at that one? There's a lot of uncertainty there. Anyway, and so all those come through. There's mercury, by the way, for those who are paying attention to mercury, and SOx and NOx for the coal-fired stuff. And that became then that stacked bar that we saw earlier here. So the game is really to go, what is a reasonable discount rate to use? What do you think? Yeah.
I really don't quite understand economic discount rate. Could you explain it? I mean, is it the interest you pay on bonds to build a big project, or does it have something to do with the Federal Reserve, how much they charge to loan money for a worthy project? And why is it discounted? That means less than something else. What is it?
It's really not the interest rate. Interestingly enough, if I go to Europe and I talk about discount rates, they always go interest rate. And so let me do this. Let me say, for the purpose of this presentation, assume for a moment that I'm financing it 100% with debt, and that's the interest rate. Then I'll come back and talk to you later about what the differences are, because I think I could get into a long discussion. I don't know if it'll be helpful for everybody. Can we do that? Okay, let's do that. Okay?
Well, Mark, if we're talking about public investment,
Yes.
why not use the cost of public borrowing?
Okay? We could, for a surrogate, what kind of number do you want to use? What's it cost to borrow money today? Public market. And you can't use those Build America bonds because those are heavily subsidized. 5? 5? 5.5? Okay.
Factor in risk.
Ah. Where do we put the risk into the equation? We could do it in the discount rate, or we can try to, or we can try and use what I'll call sort of a pure discount rate and risk adjust our other numbers. We get better results if we try and put the risk in the capital cost, O&M fuel estimates, and not in the discount rate, because then that discount rate adjustment sort of assumes all the projects have the same risk, when I think they're different in their profile, and so we're really better off adjusting it within each project. Yes?
Does it have to do with the value of the dollar as time goes on? It's in project, there's always the thought of spending today's money because it's cheaper today than next year or the next year after.
You can think of it in those terms. I think there's a technical discussion about how much of inflation expectation is really in there, as opposed to pure discount rate as sort of the lost opportunity you have by sort of making choices. But I think for this purpose, just assume it's 100% debt finance and you have to go borrow the money. Let's try that as a general simplifying assumption to roll it forward. Yeah?
You can look to industry and you can look to the finance community to see what kind of risk they put in various projects.
Yes.
And you can look at the rural utility services, the federal government, to see what kind of restrictions and risk they are placing on carbon. You can look to the finance community and the big financiers to see what price they are putting on carbon. And you can clearly see that you need to add a separate number, as you suggested, for projects that involve a high carbon risk.
Yeah.
And you don't have to look any further than the market for those numbers.
Yeah. No, you can definitely get a lot of information publicly out there in the marketplace. But you
I would just like to comment, I just heard that RUS is not loaning money on any coal plants.
And that came effective under the Bush administration, just to be clear. And that is because the Supreme Court decided or determined that greenhouse gas was...
It's because of the risk on the carbon tax. Yep.
All right. Let's go ahead and look at the 4% real discount rate and see how that changed the puzzle. And we look at our hydro and notice how well it comes down relative to what we saw before. So if we're just comparing sort of a 4 to a 7, let's see if it's... let me see if I can get this. There we go. Now you can see the sensitivity. Thanks. All right. Scale should line at 160 at the top, the projects you've seen at the bottom with the scales. I changed the discount rate. Let's assume it's the interest rate to make it sort of simpler. 7% versus 4. Huh. I might be willing to take a pretty big risk on hydro if I really think I can get cheap money. If I think I could commit resources and not lose a lot of opportunity.
Where are you going to get the steel from?
Mark, the other thing I see on this is if you think about stability of pricing,
Walked away from it and not done much. I think if you understand hedging as a way of reducing your risk as opposed to reducing your price, there's still room to do it, and I think come in a little tighter on this. But I think it's particularly today when we have cost of power adjustment clauses for our electric utilities. It's a very real volatility that homeowners and businesses have to endure. It's a very real factor. And that's why that yellow is something to be looked at and go, what's my exposure there? As opposed to, let me build something that has a lot of capital and that exposure to a capital cost overrun. I think it's very much part of it. Anyway, the real discount rate is the only thing we've changed here between these two, which is really sort of that interest rate, if you will. And so there's a little more capital intensity with the hydro and the coal relative to the gas, and you see that reflected there. Price of fuel. Yes?
It seems to me you skipped over the fact that even though on the coal side, you made a case that the fuel is less volatile because of that size of that square.
Yes.
But the fuel is linked to the cost above it. I mean, that whole thing is fuel-based. If it's a carbon tax,
Yes.
environmental thing.
Yes.
So the risk is entirely that whole rest of the column, and that makes it look a lot worse in comparison.
I'd caution against that particular frame, and I'll tell you why. When I look at market analysis and they work through the numbers and assume carbon taxes go up, there's sort of an opposite reaction. It's not equal and opposite, but an opposite reaction on the fuel supplier side to reduce their cost structure to stay competitive. So they tend to be countervailing when you're running them out. The environmental costs under most greenhouse gas emissions projections I've seen dominate that equation. But you want to be careful about sort of overstating the fuel volatility on coal, because I do think you can see both instances where coal has definitely priced up given the market, and you also see cases where coal has said, okay, environmental regulations are coming in, I'm going to price down to stay in the game. So there is some flexibility in that market.
So you've made a wonderful convoluted case for why I think you should look at the hydro and say, because of all that, which I think all the things that you just said, I think indicate to me that there is an embodied risk that doesn't exist in the hydro option.
Hydro has its own set. Capital cost risk
They're not reflected there.
pretty significant. Well, I try to capture it by having two prices for the same project. There's definitely variation in what's a hydro project going to come in at. All right.
How much loss is that with the transmission lines from your hydro?
What do I have in there for that? I'm going to guess the line loss across most of this stuff is probably pretty close to 6-7%, something like that. There may be a little bit more.
Is that figuring both the Healy and also the Sitna?
Yeah, so part of the cheat on this particular presentation is I don't have to take into account the Susitna upgrades as much, because Chakachamna doesn't require quite as much upgrade in the transmission system. So we don't have quite the same exposure. But it's part of the puzzle to worry about.
6%?
6, 7, somewhere right in there, I think is what's built in. Okay, let's dive down into how long is the hydro going to last?
50 years.
Is 50 enough?
They have to be relicensed after 50
Unless there's an
years.
earthquake.
All right, let's vote. How many say 50 is long enough? If you want it to be 50 years. Now keep your hand up if you think 60, 70, 80, 90. I'm going to go ahead and put 75 in there. How about 100? Do we have 100? There's a few votes for 100. 1, 2, 3, 75. 75 looks like a kind of a number that's out there. Now, with any luck at all, we drop down, and there's the 75 coming in there. Doesn't make a lot of difference. even at 4% discount rate. Because those out years between 50 and 75 are quite a ways out there if you're doing discounting. That's what we're seeing. It helps. It did help. All right, what else we want to look at? Capital costs. Those are hard to judge unless you're down in the weeds. The economic life, though, is one that people, you know, you can make a pretty good guess and go, no, I don't like that. I want it to be bigger or longer. Coal. Do you think we can get 50 years out of a coal-fired power plant like Healy 1?
Why would you?
Well, sometimes you do because you have to. What do you think? 50, Henry? Can I get 50 out of you? We've done it.
Wainwright.
We've done it. Huh. So we've gotten more life out of that. Natural gas turbines, it turns out, you're getting a little more life out of those because people have been slow to replace. But the 40 and the 30, I think there isn't bad. I do think there's a very real question about, do we use 50, 60, 70 years on hydro? It turns out, as we may have noticed, it's not that critical compared to the question about what is that discount rate or what's that interest rate that we're going to be charged for that project. Now, let's see if we can get back up. Capacity factors, let's just leave that as sort of down in the weeds. Fuel prices, what's that gas price there coming from? What's that about? All right. What I've tried to do is capture a weighted average as a first starting point of sort of local gas resources with a small market premium for the Cook Inlet, for the Railbelt, for the interior, and all the various places where we still might find some gas, whether it's conventional, coal bed methane, shale, various other kinds of sort of gas opportunities. Then I've said, all right, let's just pick a number for what the probability is that we'll have natural gas in Fairbanks from the North Slope, and run that out as an arbitrage opportunity off of a large pipeline. And then look at that gas being delivered to the Cook Inlet. And as you may note, if you deliver gas to Fairbanks from the North Slope on a big pipeline compared to the Cook Inlet, you have a nice price opportunity to generate power and sell it to Anchorage. And sort of reverse the course that we've had for a few years. Anyway, so that's one way to sort of get at, all right, let's just start doing some probability weighting and pick some numbers. There's no magic in sort of my view of this. And the uncertainty that we face in natural gas pricing in Alaska, in my mind, is much larger than the uncertainty reflected in that earlier graph we had from the EIA. They clearly have a market that's got a lot of supply that can sort of push that market. We might have a market that has a lot of supply, but it's not here yet. Brian.
Just looking at those numbers, that would seem to me to argue for natural gas-fired generation in Fairbanks in 2018. Once you know that this assumes a pipeline in 2020, when you're within a couple of years of that, the number would change dramatically if you were 2 years away from pipe gas to Fairbanks.
Absolutely. You know, and certainly one of the considerations when you're sitting on an Anchorage Municipal Utility Board is, all right, 10 years from now, where am I going to be buying my natural gas for my gas turbines? Or do I run those down and buy gas from somebody else who's going to basically put it on the line and, you know, and generate it and send it down south through an intertie that's not big enough? So yeah, I think that's a very real consideration. Yes?
Just for everybody's news, we're planning a pipeline and it looks like it could conceivably start up in 2014, deliver natural gas to Fairbanks.
Yeah, and it's well reported in the Petroleum News. Yeah. Yes?
Yes, the Republican write-in candidate that is somewhat hesitant. I mean, she's adamant about not having natural gas. So what does that do to your equation here?
I'm going to go ahead and punt that. I'm going to punt it this. I'm going to punt it this way, though. I think that one of the considerations that I think you have to look at if you're involved in the investment decision is what's the political risk, and there's sort of a few different dimensions. What's the political risk of me making an investment or being part of a team that makes an investment in a project if I'm going to get competition from a politically selected project? That creates political risk in my equation, and I may or may not make that investment depending on how volatile I think the market is. Happens a lot. I mean, when you think about, do I want to put a hydro project in if the local political climate is they have a favorite hydro project that they're pushing, and I would have a competing hydro project. Well, if I'm not the favorite and there's a surplus of money in the state coffers, 10, 11, 12 billion dollars, why do I want to risk private capital in that market? I don't. A lot of the discussion we've had about energy projects starting in about 2007 and 2008 with the run-up in oil prices has been quite effective at reducing the interest of private sector capital in Alaska for standalone projects and shuffled sort of their attention to projects where they leverage government money so they reduce their risk associated with that investment. If the government's going to spend a bunch of money on energy projects, the private interests have to get in line or lose out, because it's a lot of capital to risk if you pick the wrong horse. So you wind up slowing down your investment cycle and you look for opportunities within the government, basically the funding stream, so you can mitigate your risk. Yes?
When you did your discount rate thinking, it wasn't clear to me whether you included the inflation of currency over a multi-decade time scale. But it's clear from the Federal Reserve actions that we're going to have that. And it will not be always the same every year or every decade. It's difficult to know what it is. One thing you can say is, though, that it will affect the price of fuel from decade to decade. And of course, world demand for the various fuels will be depending also upon population and economic growth globally. Whereas if you do an investment in a hydro project, you have your costs rather well defined and in the next 5 or so years when you're doing it. So one thing I can say, in my opinion at least, is that if you're sitting on the board of a company that has petroleum resources in the ground and you want to optimize your rate of return, you're going to insist that your rate of return be higher than the inflation rate. And in fact, higher than the inflation rate plus the bond rate. That's why Exxon and others want 14 and 15%. And if they don't get it, they'll leave the resources in the ground. What this says is that the fuel costs are really going to go up. Please comment.
I think if I look back over a long period of time, what I see is volatility in fuel prices, not an upward trend. Now, fast forward to 2008, I'm looking now at numbers that are climbing above the long-term sort of band of volatility. Is there something fundamental that's changed in markets in terms of supply and demand and technology, our ability to go get oil and find it in various places? And do we sort of get an equilibrium and environmental regulation in that mix over some long term? And I think the answer really goes back to one of the earlier slides. Yes, there's a long-term upward trend in most projections today that a lot of folks would have been skeptical about in the 70s and the 80s and even into the 90s. They're not so skeptical now. how big is the long-term trend? If you can answer that, I'll hire you. That's the question. We don't know.
The thing that's driving it is that if you take the population demographics for 50 years,
Yeah.
they're roughly giving you around a 2% growth rate in demand for, let's say, petroleum. And if you look at OPEC and what they can do, they are going to be increasing their output for a while. But somewhere in 3 to 5, 6 years time from now, they are going to have to level off. And other kinds of alternatives for energy have to be provided.
Yeah, I would say the conventional wisdom in the forecasters is that window's a little further out than that. But, you know, who knows? I don't know. How fast does technology improve to find deep water oil? Oil in the Arctic. Who's going to let us explore or not? What's sort of that whole conversation, I think, creates uncertainty. And that's the nut. How do we deal with that uncertainty? Let me get you guys to vote on gas prices before we get too far down some of these other trails. I stuck a number in there that's basically about $9. What do you think? 10? What do you think? 8? 9? $10? This is over the time horizon. This is I've taken the time horizon out and then brought it back, if you will. Let's show you where that comes from. Real dollars, real dollars. And so here's the projection from the EIA. There you go. And you'll see it goes up in real dollars over time, over a 24-year horizon is what I've got in here to get started. And that when you do the weighted average and pick your numbers, you come up with about, $9. But I think you guys pick a number. What do you think? $9. $9? All right. 11. Well, we can run at 11 if I can find my way back. All right. Gas is starting to look more expensive. In fact, it's getting pretty close to coal. And that's coal, a new coal-fired power plant, including a $36 a ton carbon tax in that number. How many of you guys have opinions about carbon taxes?
3 years ago, you were using 24 as a...
Yes, that's correct. I'm up to 36 now, despite the change in the House of Representatives. I must be crazy. Why did I do that? The answer is I'm basically trying to keep track of private sector internal estimates from oil companies, among others, who are looking at risk adjustments, and their numbers have come up. That's where that comes from.
Is that imported price you're talking of, or
That what I'm
price?
yeah, what I'm talking about there is the long run potential price we might be paying for greenhouse gas emissions, whether it is a tax, a cap and trade system, or a best available control technology regulation, the combination of all those things going forward 30, 40 years. Let's pick a number, because it's not going to be free. We're going to have continual environmental regulation. It's going to have some cost imposed on that. Let's go ahead and run that up, just for fun. See if it works. Okay, we're at 4. Oh wow, huh? Hydro's looking pretty attractive. Gas doesn't have a big blue thing, but there are emissions there. Coal clearly has a lot of stuff to make up. Now, at some point, that gets high enough, and I'm going to say $60 where I just stuck in is about the point where you really start looking at capturing the carbon and putting it back down in the ground, enhanced oil recovery or other things, somewhere in that range. So it doesn't escalate on up forever. But that gives you an idea. If we're at 4% discount rate, the fuel prices were at 12, and the carbon tax at about 60. Even a fairly volatile and expensive hydro project still looks like a very interesting bet to make. Any other votes you want to take?
Why don't you try 14 for your gas price?
14, all right. And let's just make sure, 14. Okay, that turned to 99. Let's make sure that 99 came in there. It did, came through there. And that should, there you go. Popped it up. There's your fuel.
Can you put your environmental costs very low at, say, 5%?
I'll get you down to 12.
Why only 12?
No, just to pick a number. On some of the bills, they put collars on the price, and a lot of them come in right around there on the low side.
$12 per ton?
$12 per ton, yeah, and I'm using metric tons, CO2 equivalent, yeah. Huh. Coal looks pretty attractive. Competitive with hydro. If we believe in the long term that that's not going to be priced.
That's only updating the left hand.
Yes, it's only updating the left hand. Yeah, in fact, we're probably better off, thank you. Let's look at this. There we go. Sorry about that. Going once, going twice, 3 times. Any other combinations you want to play with just for fun to see how sensitive it is?
I'd like to suggest 1 point lower discount for hydro, just on a values base, that I would rather have renewable electricity than any other choice.
All right, let's do it. Hydro.
I think we should deny it.
You'll have ample opportunity to do that, I'm sure, in another venue.
Oh, yeah.
All right, 3, 3, and the rest are 4. I wouldn't normally do that, but let's just do it to look at it. There you go. Hydro coming down. All right. You ready to vote in the general election? Oh, Brian, I'm sorry.
No, go ahead.
All right, we're going to go top to bottom. How long are these things going to last? Do I have any votes for changing those numbers, or they look fine? Yes.
Why does it matter if the amortization period is 30 years?
Why does it matter? The short answer is, see this capital recovery number here? That will change. Let's just look real closely at natural gas. Let's just say it's 20 years instead of 30. You see it's $71 based on that combination of things. If I go to 20 years, I've added some more money. That's the sensitivity there. The shorter periods, it's more sensitive. The longer periods, it doesn't tend to have as much impact because of the discount. All right. 75? All right, let's leave it. That's fine. Discount rates. All right, this is your chance to get fancy on the big mystery number. All right, looks like you sold them. 3% on hydro, 4% on everything else.
Don't you need 2 numbers, the base rate plus the risk factor?
It's a real discount rate, and I really tend to want to put my risk factors in the cash flows rather than in the discount rate, just because it's cleaner analytically and you're not double counting that way. You can get into a problem where you're really double counting risk when you go in and you go, well, I'm going to adjust all these cash flows and then I'm going to adjust the discount rate again. So it's a little dicey, which is why I think, thanks for reminding me, I want to push that back up to 4.
Why are we voting on something so archaic?
Because it makes a difference.
If it's so obsolete, why are we voting on something that's, you know, this is nanotechnology, this is the millennium. These are students that have been graduated for hundreds of years. No, I mean, you know.
Here's why I think
somebody better get with the program
here's why I think that these are, in my mind, projects that
There are
are,
lobbyists that enforce this kind of
that are economically attractive to an investor.
they're lobbyists.
There are lobbyists who work for those investors, no
They pay
doubt.
well, they pay well.
But I'm going to suggest to you that
They suck.
they're not the dominant factor in the equation. In my experience, and I'm serious about this. My
If it was
experience,
dominant, who would be, who would you elect?
in my experience,
What would you
Alaska is
elect?
a small state.
What would you elect for having energy of the
I'll give you a
future?
minute, then it'll be my turn. You ready?
Energy of the future. Who would you vote for?
Doesn't matter who I'm going to vote for. Here's what I'm going to tell you though.
What would you have?
On
for your
both sides,
children,
on both sides
for
of
your
the aisle,
grandkids?
on both sides of the
What would
aisle,
you have for an energy?
I'm making that decision on the board of directors. And you know what we've done? Just go ahead and respond to that, and then I'll make another
I
point.
don't know. It depends
Here,
on
you
how
ready?
much we're paid by law.
15 years ago, Alaska Power and Telephone was 80% diesel. We are now 20% diesel.
Well, they had to enforce it, you know, they had to.
80% diesel, 20% diesel. That's where we're at today. And let me suggest to you that there are not other utilities in Alaska who have made that jump. And that a lot of that jump was private investment and not government investment. So it's a very interesting counterfactual. Yes, Brian?
You've got different capacity factors on the two Chakachanda. Why? It's the same size.
It's the same size project, but the analysis by Bechtel suggested the amount of water they could flow through that and meet all their environmental requirements was about 45%. So that was how much sales you could get out of that capacity. And TDX believes they can get more out of that same structure. They can get more of that water and sell it.
And did the other four assume any combined heat and power?
No, these don't have that in there to complicate it.
So if there were a combined heat and power opportunity to take heat off of either of the natural gas ones, for example, that would improve the economics.
The economics would improve. They don't tend to be as big as you might think. They're maybe 10%, and some of these other things we're messing, or 15. The other things we're messing with tend to dominate. The discount factor tends to dominate. Fuel price uncertainty tends to dominate. But it's a factor.
Do you put any value on the fact that the hydro graph you just showed was pretty stable in relation to carbon tax and fuel price? I mean, is stability and security worth something over volatility?
Stability and security is worth something, and what I encourage
I might
people...
have missed that part of your
Yeah, and what I encourage people to try and do is incorporate that into the estimates. And so you go, what's the equivalent flat rate I want out of natural gas, even if the average price is 12, let's bump it to 14 to represent sort of that premium if I had to hedge that gas, and what would it be long term?
But years ago, you wouldn't have predicted oil would be so high as it is now.
Remember, you're still working for a living.
But I mean, you're talking about the 80s. Oh, in the 80s, this and that. You wouldn't have said, oh, it's going to be $100 a barrel.
I think actually there were two periods where price projections for oil came in the range of what we saw it reach. And one was the panic in the mid-70s, 74, with the Arab oil embargo. And then again in the 80s, the run-up in the Gulf War. I think, and then right after that, if I look at the EIA price projections and the international ones, boy, a bunch of them wound up putting in what I'll call hockey stick graphs for the price of oil at those snapshots in time because people were panicked. Would I have made that those hockey stick projections? No, because I was trained by Arlen Tusing, and if you know Arlen, he's been for years and years and years on about sort of the long-run levelized cost of energy. But others, I think, did, and it was quite popular. So no, I wouldn't have predicted, I wouldn't have predicted oil as $100 a barrel. I wouldn't have made that prediction. I'd be wrong, based on what I've done in the past. I would have missed it. Yeah.
Real basic question. What effect does something like the development of a $2,000 car in India have on projected fuel prices? I would think that would have a very unpredictable and major influence.
I think there's some useful stuff that's relatively easy to digest in The Economist that talks about the growth of the automobile worldwide, particularly with the Chinese and Indian markets. And mostly what I think the takeaway from those articles is that petroleum demand will increase and we'll look for more substitutes. And there might be a slight upward trend in the price, basically, of fuel, of fossil fuel or other fuel substitutes, or even electric cars for that matter, to fuel those. But it's not big drama. It's gradual, sort of slow, upward trending kind of data. So I think that's conventional wisdom, you know, and it's been wrong before, as was highlighted earlier. So we'll you know, I think that's the way, that's the conventional wisdom. Okay. You want to move the gas price up or down? You're like it kind of at 14. I think Tokyo Light and Power might be paying around 14 today. It's not a bad number to throw in there. Greenhouse gas. What do you think? Too low? Should be higher? We're looking out 30 years, 40 years, 75 years in the case of the hydro. But this winds up affecting, as you'll see here, the 40-year lives on the coal. Henry, what are you using? You've had to think about it.
No, we're still playing the spread.
Good answer. Anyone else want to pick a number?
$30.
30?
30, yeah.
24? 24. All right. Any final votes? You want to change any of the numbers and we'll look at the results. General election time.
Why is the fuel supply for the first two only $2?
Coal.
Oh, because it's
Yeah, dollars per million BTUs. 1,000 is the MM. All right. Well, thank you very much for your attention. I know this is a little bit of a slog relative to most presentations, but I think it's really helpful, at least in my mind, to get a little bit of interaction with the data and partly to get a sense of where people are at. You know, what's important and what's your impression about where things should be? Capital, environmental, and fuel. How do you balance those, sort of the risks in each of those categories? You guys like hydro, don't you? No. Oh, we got some who don't like hydro.
I like coal
You like coal?
because it employs a lot of people.
Yeah, there's that O&M. That's exactly what that is. That's local people working right there. And hydro, not too many people. Natural gas, a few. Coal's definitely got employment. So if you're a coal fan, that greenhouse gas cost is a big piece of the puzzle, what your exposure is there.
Alaska can afford.
Yes, Brian.
Well, the other issue is this portion of your presentation just focused on production of electricity.
Yes.
And the home heating and transportation have very different answers, if they have answers.
They do have different and interrelated answers. Sometimes when I try and work my way through the entire sort of stack of options, which is what this is, and I'm not going to, just to show you how much fun it is when you try and do a timeline at the top and then work through all the various combinations and then work through gas supply contracts and try and puzzle the whole thing together. It does all tend to get interrelated. And a classic example, if I build a large hydro resource and I use standard investment criteria, I do not build a gas line from Fairbanks to Anchorage. I do not need that gas line. It doesn't pencil out. Basically, that hydro resource becomes economic under a high sort of gas thing, and it starts to displace some of that demand for power. And so now I'm trying to ride all of that demand on the heating customers, and I can't make it. And so it frequently, with large hydro projects, in the Railbelt mix, I wind up trimming the opportunity for a line from Fairbanks to Anchorage. That's only if you look at it from a sort of a dollars, or I need to discount my dollars and I got to collect them all. Okay, well, I do want to thank you. How are we doing on time? I have a suspicion I didn't pay any attention, so we may be over. Thank you very much. Any last questions, comments? No? Good. Thank you.